Hey everybody, hey traders, Chris over here. Welcome back. This video is going to be part of my Trading 101 video series. I'm talking about options trading, and this is going to be video 2 of my installment. I'm getting a little bit more advanced, but don't let that scare you. I'm just going to keep option trading very simple. This is going to be part 2. Okay, I'll put this right here. Part 2. And we're going to talk about credit spreads. Right? That's going to include a bull put spread, bear call spread. What are they? Why do we trade them? How do we manage our risk? All that good stuff. So this is going to be part 2 for my options trading 101. I'm going to have 3 to 4 videos here. And again, all questions are welcome. Feedback, comment, all that good stuff. Let me know. And that's it. So I'm going to go back into this screenshot here. I just did my first video on the long call and the long put, just simple long options. That is done. Check that video out if you want. This video is going to be focused on a bull put spread and a bear call spread. Now, I personally prefer to do credit spreads. Okay, I'm going to make this a little bit thicker. So I prefer to do credit spreads, which means I sell to open at a strike price and I buy to open at a strike price. Now, I'll explain all that. A bull put spread. This is a bullish position. It means I want the asset price to go up and stay above my sell put level. Okay? So this is going to be an example. And again, for the sake of simplicity, I'll just use Apple like I did in video 1. So let's talk about this. If Apple is trading at, I'll use the same prices for my videos. Let's say Apple price, so the share price of Apple is $150 per share. Okay? If I want to do something at the money, I'm going to sell to open a 150 put. I'm going to buy to open, let's say a 149 put. If the broker will offer me 45 to 50 cents credit, that means I collect 45 to 50 cents per contract to take this trade. Okay? Now, remember an option contract, let's just round it, say 50 cents. 50 cents times one contract, which is the same as 100 shares, is going to be $50. So if I am correct on this trade, I can win $50. If I'm wrong on the trade, I'm risking $50. So it's a defined risk trade. I can't lose more than 50 cents, and I can't make more than 50 cents. So it's a defined risk and reward trade. Okay? So if Apple goes to $200 a share, I'm still going to make $50. If Apple goes down to 0, I'm still going to lose $50. Right? That's kind of nice. So it's a trade. Now, what I need this to do, this is again a bull put credit spread. You also see this in your broker platforms listed as a vertical spread. If you're selling the 150 put and you're buying the 149 put, that is a credit spread. Okay? So I can collect the 45 or 50 cents up front, and time works in our favor. So if it's Monday and I execute this trade, I sell the 150 put, I buy the 149 put, I collect 50 cents. So Monday, I execute the trade. Okay? Friday, by closing bell, okay, if Apple is 150.01 or higher, I keep full profit. That's all it needs to do. So essentially, my 150 put is my line in the sand. If price stays above that, I can keep my full profit by closing bell expiration. Okay? If Apple is 148.99 or lower, I lose the defined risk, which if I collected 50 cents would be the remaining 50 cents because it's a dollar spread, right? The 150 minus 149, that's a dollar spread. I'm collecting 50 cents. So if it's 148.99 or lower, like I said, Apple could go literally to 0 and I would still only lose 50 cents in the trade. Apple could also go up to $1,000 to infinity. I'd still only make 50 cents a trade. Okay? So it gives me a line in the sand where if this is my sell put level, this is my buy put level, and the underlying asset stays above it, I can keep the max profit by expiration, and I don't even have to close out the trade. I can let the trade expire in full profit by Friday closing bell or the expiration. Does that make sense? Okay. Now, there's one other scenario just to be aware of. If it is in between, okay? If Apple is between 149 and 150 by expiration day, here's what I like to do. I try to close for break even or better. Okay, now think about this. If you trade on the dollar spread, you collected 50 cents. That means my true break even is 149.50. So if the asset price is 149.50, 149.55, 149.45, I should be able to close out that trade the day of expiration for break even. Now, realistically, I'm comfortable taking a small loss. Like if I only lost 5 cents instead of 50 cents, if I lost, 10 cents instead of 50 cents, I consider that it's a trade that didn't work. It's not above my 150 strike. I'll take a loss, but it's a fractional loss. So my max profit would have been 50 cents. If it's somewhere in between and it's clearly not going to make me full profit, if I can close it for break even or better, or even accept like a 5 or 10 or partial loss, that's certainly better than taking a full loss. Okay. So I try to close it for break even or better, or accept a loss that is less than the original max risk, right? So if it's trading for, it's a dollar spread and it's trading for, price of Apple is 149.10. I'm like, well, it's on the lower end, I'm technically upside down 40 cents on the trade. Look, if you close it out right now for 40 cents, you're still saving yourself 10 cents of risk. It's okay. Worst case is it drops down below 149 and now you're completely worthless on the option trade. You're going to lose your 50 cents. Is it that big of a deal? It's up to you. Okay. But the idea here is you define the risk. You have a line in the sand. If you do a bull put credit spread and you put that line in the sand at 150, all you need price to do is stay above it by expiration, and that's your full profit on what you collected on the credit. So pretty straightforward. You know your reward, you know your risk, and you know that all up front. I trade these all the time. Why do I do credit spreads? If I think that price is dipping or at a bottom, I like to do credit spreads right here, right? I can do an expiration for this month and another month and another month, or week to week to week, and I can stagger them out. And a lot of times this helps because if price goes up and I can have a winner, another winner, another winner, I could generate several weeks or several months worth of income on that asset by just timing the technicals and then having the asset price go up. And what's nice is, if the price is way above where I started my credit spread, the time decay works in our favor. Just a fancy way of saying I can make full profit at expiration, and I can make most of my profit if the asset price is significantly higher than this strike price. So as an example, if I called this level, and this is my 150 by 149, and 3 weeks later Apple's trading at $200, I don't care if I went out months for expirations. These are going to be worth like 80 to 90% profit, and I don't have to wait the full 2, 3, 4 months of expirations to get that profit. I can take majority of it right now if I want to, if the asset price is moving aggressively. All right, so that's a bull put spread. Again, some of your brokers listed as a vertical spread. If you're selling and buying, I'm selling the top, so that's a 150 put. I'm buying the 149. I collect a credit on that. I love this trade. Now, that is a bullish position. I want the price to go higher in a bull put spread. Now, let's flip it around and do a bear call spread. So we'll do the same thing. Apple is trading at $150 per share. And for a bear call spread, I believe price is going to go lower. So I want Apple to drop in price. So I can sell to open the 150 call, and I can buy to open the 151 call. Okay, so you can see here that the 150 remains my line in the sand. All right. And if I sell the 150 call and I buy the 151 call, as long as Apple is 149.99 or lower by expiration, I keep full credit on the trade, right? So if I took this trade and I collected 50 cents, as long as price is below my 150 call by expiration, I keep full credit on the trade, okay? Which means that if Apple goes down to $100, I keep my 50 cents. If Apple goes up to $200, I'm risking 50 cents. Okay, so we're going to say here that we collect 50 cents credit. Okay, so the line in the sand is 150. If price goes up a ton, this is a dollar spread. I'm collecting 50 cents. And a lot of times, if you're trading at the money like this, if the price is $150 on Apple and I'm doing a 150 by 151, I might be able to collect 40 cents. Okay, I might be able to collect 45 cents. I like to take these trades where I can at least collect 50 to 55 cents because if I can slightly give myself an edge of, okay, so I can make 55 cents on a win and I lose 45 cents on a loss. And I do that over 100 trades. Well, if I have a 50-50 win percentage, I'll make money. Right now what's funny is my equities on demand trading room, I've been running this for the last 2.5 years. We've logged, I think I put this in a Telegram channel. We've logged a ton of trades. Let me see what this is. Equities on demand. I think I posted this last week for some feedback. We have a 61.4% win percentage, and we are most of the time taking at least 50% of the credit. So I don't like to take less than that. So example being, if I collected 50 cents on every one of these trades and I lose 50 cents on all these trades, I'm still making money because my win percentage is high. If I can make this slightly favorable where I make 55 cents, let's look at the difference here just really quickly. If I did every time I take a trade, okay, if every time I win 55 cents and I have that by 346 wins, I have $190.30 of net credit. I'm going to write that down. So $190.30. Okay, now that doesn't mean that that's what I'm up because I still have to take losses. I take my $217 of losses. So $217 of losses at a 45-cent loss, that's $97.65. So the difference would be $92 in profit. I'd be up $92.65 of credit at one contract. At one contract, I'm up over $9,000 over the last couple of years by just simply taking credit spreads around this like 50% level, 55% level, right? If it's a dollar spread, if I can get 55 cents, awesome, right? If it's a dollar spread, I get 50 cents. I still win. So the math I'm doing here, if I roughly took 50%, that'd be 346 times 50 cents is 173. I'll remember that number, 173. So 173. So I'm still up $64, but you can see they're just carving out an extra 5 cents makes almost $30 in credit different. So a little bit goes a long way by just having that slight edge. A 55% winner or a 55-cent winner to a 45-cent loser makes a big difference, right? But even 50-50 with a good win percentage, you still make a lot of money. Okay, so what are we doing here on the bear call spread? Well, the bear call spread is this. If I believe price is going to go down, let's say that we've hit over ridiculous overbought conditions, and the market starts to look a little bit toppy. Then I put in a bear call spread where I sell the call, I buy the call. If price goes lower, as long as it stays below that sell call level, I can keep that max profit. Okay, so if you think the market has rallied a ton and it's overbought, I typically look at maybe taking a couple of stabs of bear call spreads. I would only take a bear call spread if I'm pretty confident that the market's going to go down. Now, this might be the stock itself, this might be the broader market, but I will never, ever, ever just sell a call naked with no underlying ownership. That's a ridiculously stupid strategy. That is the most risky thing. So it's always going to be, if I'm bearish on the market, I am never just bearish on a stock by selling a stock on margin. I would do two things. I would, one, do a bear call spread if I'm bearish, or two, I would do a long put if I'm bearish. And that's about it. Because that way, it's always a defined risk trade. If the stock price goes up to infinity, a bear call spread has a defined risk. A long put strategy has a defined risk. I can only lose the maximum of what I paid for the option contract. But if you do not own shares, do not ever just sell a stock. That is stupid. Because you're selling on margin, it's super expensive, and obviously if the price goes up, you're responsible for every dollar share it moves against you, and a lot of traders get crushed on that. Okay? So that is a pretty simple way to explain a bull put spread, and a bear call spread. This is Options Trading 101. This is video 2 in this installment. And check out the next video where I'll talk about, I'll just go down the list here. We're going to do a credit spread repair. I'll talk about what that is. And then a covered call strategy with shares you own. That'll be installment 3. And then I'm going to do a bonus one that'll be video 4 on some fancier names. And we do this quite a bit during my Delta Trader and week to week because we essentially just need price to go somewhere. Price goes up, price goes down. We can take both sides of the trade and see if one leg can pay out more than the other. So I'll get to those videos next. But thanks for watching. If you're not a subscriber, please subscribe, like the video, leave a comment, all that good stuff on YouTube. Support the channel. I appreciate it. And I'll see you in the next video. Thanks.